Hey everyone, Longacres Finance here with 5 high dividend growth stocks from the information technology sector. It's no secret that technology has been one of the best sectors in the market during the last decade, and it may continue to outperform in the future. These 5 companies have all paid and increased their dividend stream for at least 10 years, and they all have a long-term dividend growth rate above 10%. In addition to growing dividend streams, investors have been rewarded with above average capital appreciation from each of these stocks. Stay tuned to see if they fit your investing needs, as we will go over each stock and make some forward-looking assumptions. Also, at the end of the video, I'll have a little bar chart race to see which of these 5 stocks would have been the best investment during the past decade. Okay, first up is Broadcom, ticker symbol AVGO. The company develops semiconductors, which are used in all types of electronics from cell phones to vehicles. Broadcom derived the revenue from 2 segments: semiconductor solutions, that accounts for about 70% of total revenue, and infrastructure software, that makes up the remaining 30%. The Semiconductor Solutions segment primarily focuses on radio frequency devices and serves the communication industry. The Infrastructure Software segment offers mainframe, enterprise, and storage area solutions to a broad range of clients. They essentially help large businesses transform into digital businesses with speed and optimization. This stock has crushed the S&P 500 over the last decade, even after a recent pullback in share price. The company has a 10-year streak of growing revenue with a strong gross profit margin above 70%. You may recall that Broadcom tried to buy Qualcomm about 3 years ago, but ultimately was blocked by the US government. Had that deal gone through, Broadcom would be significantly larger today. The semiconductor industry is forecast to continue growing in the future, and I think Broadcom will benefit from industry growth. In addition to this growth, Broadcom offers an attractive dividend stream, considering the above-average capital appreciation investors have been privy to. The forward dividend yield is around 3%, and this is actually one of the best dividend yields the stock has offered historically, barring the 6% dividend yield during the March 2020 market lows. Broadcom was historically a sub 2% dividend yield stock. The reason the dividend yield has increased recently is because dividend growth has been even better than share price growth during the past decade. You can see here the past 10-year dividend growth rate has averaged almost 70%. It has slowed down a bit lately with a 41% increase in 2019 and a 19% increase last year, but this is to be expected. A 70% dividend growth rate is unsustainable over a long term, although this streak has been beyond investor expectations. So what about in the future? I think Broadcom can sustain a double-digit growth rate for the next few years, which is still a very respectable growth rate that can help grow your future passive income stream. The company has also returned about 50% of normalized free cash flow back to investors, both through dividends and buybacks. If the company continues to grow and follow this same distribution split, you can count on the dividend stream to grow as well. CFRA has a strong buy recommendation for the stock with a $510 price target. They are also forecasting forward earnings per share growth of 17% per year. That is a very nice growth rate. The next stock on my list is KLA Corporation, ticker symbol KLAC. They are a designer, manufacturer, and marketer of process control and yield management solutions for the semiconductor and other nanoelectronic industries. Basically, they help semiconductor companies and other tech firms test their wafers, reticles, integrated circuits, and LEDs. So they serve a fast-growing industry, and KLA is an industry leader with a significant share of this market. While its 10-year return isn't as impressive as Broadcom's, the stock has still crushed the S&P 500. Revenue has taken off around 2016 and has doubled over the last few years. KLA currently pays a 1.13% dividend yield, but has grown that dividend stream at an average rate of 15.9% over the last decade. That growth hasn't been very consistent, with some years significantly better than others, but I think the stock can maintain a double-digit growth rate over the long term in the future. CFRA currently has a buy recommendation for the stock with a price target of $315. They are also projecting EPS growth rate of a whopping 39% in the near future, suggesting potential upside for the stock. I think KLA will also benefit from the continued growth in the semiconductor industry. The next stock on my list is Microsoft, which all of you should be familiar with. Microsoft has also rocked the S&P 500 in terms of total return during the past decade. Revenues have grown consistently with a nice little takeoff here since late 2016. Microsoft has paid and increased its dividend for 17 years now. Currently, they pay a low 0.95% dividend yield, but they have been growing that dividend payment at a rate of 14% over the past 10 years. The growth has slowed a little over the last 5 years or so, but remains strong. The share price has grown much quicker than the dividend stream, and therefore the dividend yield has declined. 5 years ago, investors could have gotten in for almost a 3% dividend yield. But since late 2016, right about when revenue started growing quicker, the dividend yield went the opposite way. But you know what this means. There are more earnings today that can be used to keep growing dividend payments in the future. CFRA has a strong buy recommendation for the stock with a price target of $280. They also forecast EPS growth at 21% over the next 3 years, suggesting the stock will continue to grow quickly. The next stock on my list is MasterCard, ticker symbol MA. They are the second largest payment processor behind only Visa. Payment processing has been an expanding industry across the globe, and MasterCard is well positioned as the number 2 stock to benefit from this growth. MasterCard has also significantly outperformed the S&P 500 during the past decade. Revenue has grown nicely with the exception of a small pullback in 2020. MasterCard pays a tiny 0.5% dividend yield, but has grown its dividend at a cool almost 40% per year since 2010. The long-term growth rate is a bit inflated by the above-average growth in 2012 to 2014. A 20% annual growth rate is a better estimate to use for future dividend growth, which is still a very, very good rate. The stock has never offered a great dividend yield historically. The yield has hovered mainly between 0.4 and 0.8% during the past 6 years, and I would expect this range to hold up in the near future. CFRA has a buy recommendation for the stock right now with a price target of $395. They also forecast EPS growth of 18% over the next 3 years, which would be a very good bottom line growth rate for the company. And the last stock on my list is Visa, the direct competitor to MasterCard. Actually, Visa has significantly more market share than MasterCard. They also benefit from the brand name recognition and security associated with the company. I think these two factors will help Visa maintain its market share in the future and capture a significant amount of the growth in the industry. Visa has crushed the S&P 500 like all the other stocks in this video in terms of total return. Revenue looks similar to that of MasterCard, solid growth with a small pullback in 2020. Visa also pays a quite small dividend yield of 0.6%, but has been growing that dividend very quickly, averaging 25% growth per year since 2010. Similar to MasterCard, Visa has never offered a high dividend yield, and probably won't offer one in the near future. CFRA has a buy recommendation for the stock with a price target of $220. They also forecast EPS growth of 16% over the next 3 years, which is a pretty attractive bottom line growth rate. The reason I like both MasterCard and Visa is that they are pure profit machines. Every time a person uses one of their credit cards, they earn money with no risk since neither actually extend credit to consumers, but merely act like middlemen taking a small fraction of each transaction. I think Microsoft is an industry leader that will maintain its market share with its suite of office products, Surface tablets and laptops, and expanding cloud business. The semiconductor industry will also remain hot in the future, as technology will only keep expanding exponentially, and will therefore keep demand high for this industry. All 5 of these stocks can offer great returns going forward. The trick is getting in for the right price, or averaging your way in over the long term. I personally prefer to dollar cost average my way in over time. Buy a little now and buy some more later, and just keep buying for years to come. This approach would have worked very well during the last 10 years or so for each of these stocks, regardless whether you purchased shares when they were over or undervalued. To show you just how well this could have worked out, let's have a little race. Let's assume you had $500 per month to invest in each of these stocks, and you started doing so in 2010. So a total of 11 years of consistent investing if we run through year-end 2020. Assuming all dividends were reinvested right back into each position, how much do you think each stock would grow your capital? And which would have been the best investment opportunity? For perspective, 11 years of monthly contributions of $500 is a total of 132 contributions, summing to $66,000. That's it guys, thank you for watching, see you next time, and enjoy the rest of the race.